Okay, and if hopefully if all things go well, we should be able to share the video of this for later reference as well. Okay. So as you might have seen in the poster, what I'm planning to do here is not to do like a full sort of like a take you through the lecture of derivatives, but to give you some intuition for particularly when it comes to the options. Because one thing I've realized is that for many of you, who are in level 1, this might be the first time that you're coming across derivatives. So some of the things, this is not something that you would have come across in your everyday life. Things like equities, bonds, that at the very least you have some vague notion of what it is. But options is something completely different. So what I'll be trying to do is just to pick out some key topics within that options material and just give you some intuition on that, and sort of like these tips and the way you can sort of remember the results and how to figure out the different payoff, how to do the calculations for the payoffs, to figuring out what is the option values, etc. Okay, and so those are the sort of things that we'll be covering in this. So I will go through. So I picked out a couple of topics on that. So what I'll do is I'll illustrate that and go through that, and I'll pause after each of those sessions. If you have any questions, just let me know. Okay, hope that sounds good. So yeah, so let's get started. So the first thing that confuses a lot of, I think even before coming to this, I think at a fundamental level, the difference that is there between options and the other type of derivatives. Okay, so we know when it comes to derivatives, we have the two types, which is the things which are commitments and the things which are contingent claims. So the things like, so under these commitments, the main characteristic of a commitment is something where the two parties in that transaction, essentially they have, both parties have an obligation to carry out a certain transaction. They have in the matter. Okay. So when it comes to that, there are a couple of different instruments that come under that. So primarily what we need to know is the forwards, the futures, and the swaps. Okay, so those are all obligations. Okay, so if we, for example, take a case like this, where you have, say, you're a manufacturer, and a key input that you need is you need some supply of oil. Okay, and what you're worried about is you need, for your future orders, you need to secure some oil, but the danger you face is that you're not sure what the price of the oil will be in the following month's time. So because of that, you can use the derivatives to try to hedge your risk. So for instance, let's assume that currently the forward the oil, the price of a barrel of oil is, let's say, $50. Okay, so this is what we know. This is today. Currently, if you go to the market and buy the oil, this is this price. So we know technically we would call this the spot price. So this is the spot market price that we have. And then what we're interested in is, in 1 month's time, what would happen to that price of oil. So let's say there are two possible options. It can either go to 70 or it can go to 30. Okay, so if the oil goes to 70 and we now enter into, let's say we have entered into this into a forward arrangement. Okay, and with a forward arrangement, the result is that today we agree upon at some future date that I'm going to buy this oil at a fixed price. And that fixed price is what we call that forward rate. Okay, so let's say the agreed upon forward rate, the forward rate or the forward price, let's say it's going to be 60. Okay, so in this situation, if your forward price rate is 60, that means that depending on the state of the world, there will be, you will either gain or you will lose out on this transaction. So you, as the party who is entering into this forward contract, where you're entering into to buy these oil by paying this forward, you would be the long party. Okay, because essentially what you're doing is you're paying a fixed amount to receive something where the price is variable. Okay, so in this context, if the barrel of oil goes to 70, you are happy about that, because you are happy that you entered into this derivative, because into this forward arrangement, because now in the market, if you had gone and bought this oil, it would have been 70, but now you can buy it for 60 effectively. So which means that you're getting this benefit of 70 minus 60, where you're getting some oil which is worth 70 by paying a price of 60. So this is the payoff that you're getting from this. Instead, if the oil had fallen to 30, unfortunately, if you had not gone for the derivative, you could have bought this at 30. But because you entered into this forward arrangement, you would need to, you're still compelled to buy this oil by paying that 60. So therefore, you get 30 minus 60. So you get a loss of 30. Okay. So when it comes to these commitments like a forward, the key characteristic is that you are obliged to go ahead with this. So which means that whether you like it or not, you need to go ahead with the transaction. So if the price had gone to 70, you're happy about it because you're getting a gain of 10. If it had fallen to 30, you don't like it, but you still need to go ahead with it, and you would get a loss of minus 30. Okay, so what happens in this situation is the obligation that you face means that you don't have a choice. You have to go ahead with this whether you like it or not. Okay, and another small point to also highlight is that this is what we illustrated here was what is the payoffs to you as the long party. Okay, but if you correspondingly, if you think about the party that is selling the oil, so in this context, they would be the short party. So the short party, so the main distinction, how we distinguish between a long party and a short party, the party that is long is the party that is receiving something that is variable by paying something that is fixed. Okay, so as in this case, you are receiving the barrel of oil where the price is variable by paying a fixed price, which is that forward price. Instead, if you're going with the short party, then what we have is that you go with so if you're the short party, you're the seller of this option of this forward, what you will get is you're receiving something that is fixed by giving something that is variable. So in this case, the short party's payoff would be 60 minus the 70. Okay, because you're receiving 60 by selling this barrel of oil which is worth 70. So you make a loss of 10. Similarly, if you're in this situation, you are selling oil which is worth 30 and you're receiving a price of 60, which is that forward rate. So you get a gain of 30. So you can see in this situation, when it's a forward contract, the payoffs are going to be symmetric. So it's basically a zero-sum game that you're faced with here. So the amount that the long party gains, the short party correspondingly loses, and vice versa. Okay? So this is the arrangement when it's a forward contract. But if instead we went with a contingent claim, so that is a situation where you have the right to do something. So, so an option is the main example of this. So if you have the right to do something, then what we say is that the long party has this right to decide whether they want to go ahead with this transaction or not. So let's say instead of a forward contract, you went for an option where under the same conditions, now you agree to to buy, if you decide to use this option, or what we call exercise this option, you'll be able to buy this oil. It gives you the right to buy this oil by paying a fixed price. So that fixed price in the derivatives context is, in the options context, is what we call the exercise price. So let's say it's the same price, 60. We call it the exercise price. Sometimes they call it the strike price. And the notation they use for that is X. Okay. So assuming that this it's the same exercise price of 60, That means that, again, these are the possible payoffs that you would face given these prices of oil. So the key thing is that now the difference between the derivative situation, between the forward situation, is that you now have a right. So you can decide to only make use of this option if it is advantageous. So you can see that if the price has risen and you're going to make this gain, then you can see that in this situation it is advantageous for you to use this option. So what we say is that you will exercise the option in this situation. So exercising the option means you basically execute it. You basically pay that exercise price and you take delivery, or you receive the particular asset that you subscribe to. Okay. If instead the price goes to 30, you can see that it's not worthwhile exercising this because you would make a loss. So instead what you do is you will not exercise. So what does it mean when you not exercise? So not exercise basically means you just allow that option to expire. You don't use it. So if you don't make use of the option, that means that you don't need to pay the strike price. You don't need to pay that exercise price, which means that you're not also going to receive the asset. So which means that your payoff effectively is going to be zero. Okay, you don't face this loss. You just allow that option to expire. So this is the main difference. So if you're the long party in an option, the long party has the right, okay, to decide when they want to use this option or not. Correspondingly, if you think about the short, now if you look at the situation that we have here, from the short's point of view, they would prefer to be what's advantageous for them is if the price falls and they would get this gain. If it rises, they lose out. So but the thing is, the way the option is structured is that the short party is always the party that has the obligation. So you still have the obligation, same as the forward contract. So which means that in this situation, when the party decides to exercise it, when the long party decides to exercise the option, you have no choice. You have to go ahead with it, and therefore you would make a loss. Okay? So you have so basically you have to do everything dependent on what the long party decides to do. So because of that, you have an obligation while the long party has a right. So because of that, this is another fundamental difference between the instruments which are like the forwards, futures, and swaps, and the derivatives, which is that the payoff structure is now going to be asymmetric. Okay, so because of that, what we will see is that in order to enter into this option contract, there would now be some additional incentive that you need to give the short party in order for them to take up this option. So that is what we call the option price. So that is the payment that the long party needs to make to the short party when they enter into this option. Okay. In the case of forwards, futures, typically there isn't an upfront fee that you have to pay to enter into this contract because the thing is symmetric. Okay, the payoffs are symmetric. But in this case, it's going to be, since it's asymmetric, you need to give the short party an additional incentive to go ahead with this. So that is what so at the start of the contract, you need to pay this option price. Yeah, so that's like the overview. I think that key distinction between what's the commitments versus the contingent price. Does anyone have any questions regarding that? Okay, just send in your questions, or you can just unmute your mic and ask me directly if there's anything not clear on this. Okay, yeah, I'm assuming that's fine. So next topic we want to get, so now that we have that idea what is an option and the right, what we want to discuss is this distinction between what is a call and what is a put. Okay, so so in the particular situation we looked at over here, where you were the party who was interested in buying this oil. So in this situation, we say that you are so you wanted to get this right to be able to buy the oil. By paying this exercise price, you're able to get this oil. So in a situation like that, a situation where an option gives you the right to buy, that is known as a call option. If instead you want the right to sell something, say you own a stock portfolio, you have a certain stock and you're worried about that you might not be able to get a good price for it. So then you want to get this option to sort of insure against the price falling too much, that you might not get a great price for it. So in a situation like that, where you buy an option which gives you the right to sell. So when you get the right to sell, what happens when you exercise it is that you are going to receive something that is fixed. You're receiving the exercise value by delivering that asset, by paying the asset that you have. So a situation like that is what we call the a put option. Okay. So if you sort of look at in terms of the actions you would have to do when you exercise the option, if you're the call, if you are long, if you're the long party on the call option, then what you need to do is if you decide to exercise the option, you pay the strike price and you receive the stock or whatever the particular asset, which we will denote as S, what we call the underlying asset. Whereas if you're long on the put option, you will receive the X, so you're receiving some fixed amount, and by paying or by delivering the particular asset that you have, which is variable. So that is the distinction between the two. Is that clear to everyone? Okay. So that's at a broad level. Be clear about what is the distinction between the call and the put option. Okay. So these are just the terminology. I think you should be familiar with this. So the underlying asset we denote it as S. So that is like the stock or whatever the particular asset that we're doing. The spot price is the current price of that asset. So usually we denote it as S naught. Okay. And the expiration date is the date when it expires. So usually it's given as capital T or just simple T. And then this is what I explained about the long and the short. So yeah, so this is what I illustrated earlier also. So this is the sort of analogy you can remember in terms of when it comes to the difference between who has the obligation and who has the right to something. So for sort of basically like in this context, so in this situation, I'm kind of the option seller because I'm doing the session, so I kind of have that obligation to do the session. Whereas you who are listening to this session, you're basically the option buyer. You all are basically the long party because you have the right. So you can decide whether to listen to this or not. Okay. So that's how you can sort of see this situation. So always the short party has the obligation and the long party, whether it's a long on a call or long on a put, has the right. Okay. So that's the main distinction between the two. Is everyone okay with that? Any questions on the distinction between long and short and the call and the put option? Okay. Yeah, I'm assuming everyone's okay with that. Then another pitfall that I find many people make is about this option price versus the strike price. They're always confused between the two. So as I was saying here, given that you have this imbalance between the risk that the long party and the short party is taking, when it comes to an option, you now have to make this additional option price. You need to pay this price to buy the option in the first place. So you buy the right to use something. So in this situation, what will happen is the long party needs to always pay the short party this option price at the start of this contract. At time 0, when you buy this contract, you need to pay this option price. So if you're buying a call option, you need to pay the call price that's given by C naught. If you buy the put option, you need to pay the put price, which is called P naught. So this is the payment that is made by the long party to the short party at the start of the contract. So this is something you have to pay to get into the option. You have no choice around this. Okay. But you have a choice about is that exercise price or the strike price. So you decide once you have paid the option price and now you have this option, you can now decide whether to use it or not. So if you decide to use it, you will you need to then pay that exercise price at the point of termination, or whenever you're executing it, or you can decide not to use that. So that strike price is optional, okay? But the option price, you have no choice. You have to pay it at the start, okay? And these are some points about that, okay? Yeah, I think someone has a question. Yes, so it would change. So the long party is the one in this situation. So yeah, so now I think I should make the distinction between how the arrangement is between the forwards versus the options. So when it comes to forwards, they also use the same terminology of the long and short. So in the forwards case, I think I have the next slide, I think is on that as well. Oops. Yeah, this distinctions between them. So yes, so the party that is paying fixed versus variable, it depends on the instrument that you're going with. So if it's a forward, or any of the ones where there's an obligation, what they call the long is the party that is paying fixed and you receive something that is variable, okay? Of course not, this does not hold always in general, but in general this is the case. This doesn't hold in every particular case. So for example, if it's like a currency forward, then there can be a situation where both parties can be paying fixed, but they are on two different currencies, okay? So there is some variability in terms of the currency, but in general, this is the usual structure that you have. The long party is the one that pays fixed and you receive variable. If you're short, you will, which means that you receive fixed and by paying a variable amount, okay? In the case of options, if you're long on the call option, there what you're doing is you now have the right to buy something. So which means that if you decide to exercise it, you will pay the fixed fee, which is that strike price, and you receive the variable, okay? So this is only in the situation where you decide to exercise the option. Similarly, if you think about who's on the other side of this transaction, that is, if you're the short party on this call transaction, that means that then you have now the obligation. You don't have the right. So which means that in this situation, you will be, yeah, so this is what I think what I'm explaining is what I've derived here. So if you're the long party, you're paying a fixed amount and you receive something that is variable. If you're on the other side of the transaction, if you're the option seller, the short party, you receive this fixed value, which is the exercise, and you have to pay that variable rate. Whereas, okay, so this is the arrangement when it comes to the call option. So just keep in mind, if you're the, just remember, since if it's confusing, just remember one thing. Just remember, if you're the long party in the call option, it gives you the right to buy the asset. So in that situation, you're paying fixed, receiving something that's variable. And the short call would be the opposite of that. So because, I mean, if you're the long party, you're paying fixed, which means that, and receiving this variable asset, which means that the short party is the one who has to accept that fixed payment and deliver that underlying, okay? So if you keep in mind what is the long calls, they are the sort of the payoff, the structure, then automatically you can figure out what is the short calls, okay? Because it's just going to be the reverse of that. Conversely, if you're long on a put, just remember the long put, that means it gives you the right to sell something. So you're selling something to get something that is fixed. So which means that you're selling something, an asset that is variable, in order to receive something that is fixed. So therefore, what you get is you receive the exercise price and you by delivering the underlying. So you're paying something that is variable. If instead you're the short party, you're short on the put option, that means that you're the party who needs to, if the long party decides to exercise this, you have to pay the, give that person the fixed price on this asset, and you take delivery of that variable asset. Okay, so that's why for them, they have to pay fixed and they receive the underlying asset. So they have an obligation. Okay, is the distinction clear between the two? So as I said, just remember, instead of thinking of these as 4 different things, just keep in mind these two, the long call and the long put, and then you can figure out what is it for the corresponding party or who is on the short side of the transaction. Okay, so other related terminology they would use is that if they say you are an option buyer, okay, an option buyer means that you're the party that is going long. So you can be, when you say you're an option buyer, it could be, you can be a long call or you could be a long put. You're just buying the right to have something. If you buy a call option, you have the right to buy. If you're buying a put option, you have the right to sell. So that's why that's called the option buyer. Similarly, if you're the option seller, that means that you could be the short call or the short put. You're selling someone the right to use this option. Okay, is that distinction clear between the differences between the derivatives, the options? Yeah, any other questions on that? Is there any more? Yeah, I think that should be okay. Whoops. Yeah, so let's move on to the next one. So now an important thing is this options payoff diagrams. So now, I mean, at the exam, they're not going to ask you to draw these things, you know, but the importance is if you get stuck, you know, if you understand how do those payoff structures work, then you can, you know, even if you forget, you can just quickly draw the diagram and figure out what is the answer. So because that, it's important to know how these payoff profiles work for the different options. So again, as I said, you don't really need to know these 4 different types. If you remember what is the payoff structure for the long call and what is the payoff structure for the put option, the long put, then you can automatically work out what is it for the short and the call and the short put. Okay. So yeah, so let's illustrate those two. Yeah, I'll draw them one below the other, same as before. So let's say over here on this axis, what we have is the underlying asset, the particular stock price or the whatever the asset price that we have at a particular time. And over here, we, let's say, have the payoff. Okay. So now if we think you are long on the call option, if you're long on the call, you have now bought this right to have this asset, right to purchase this asset if you choose to. So if you can see, there are 2 possible outcomes going back to that initial example that we had. So we saw that, you know, it would be, if you're long on this call option, it is advantageous for you to exercise this option in this situation. What happened when the spot price increased above that fixed, basically when the price of oil went to 70, you were happy to exercise it because now you can buy this barrel of oil which is worth 70 by paying 60, which was the strike price, the exercise price. So you can see that if you're long on the call option, it would be advantageous to exercise the option if as long as the underlying price is above that exercise price. So that is the condition when you would exercise this option. So if S is greater than X, that means that you would exercise the option. Is that understood? So that is the result. So if you exercise when S is greater than X, then what does it mean when you exercise? That means that you now pay the strike price and you receive the underlying. So which means that what you will get is that you will get if you take in terms of your payoff for this. So this is the action that you're going to take, is you exercise. Correspondingly, the payoff you're going to get is going to be given by, let's say ST is the time period when the stock price, at the time when you have to execute this, is the stock price that is there. Say, let's assume this is a European call option. So you can exercise this only at that expiration date. So in that situation, this would be the payoff, ST minus X. And you can see, given that ST is greater than X, that means that the payoff is going to be positive. Is that clear? So that is the payoff you would get if you exercise this. So let's let's just run through the different possibilities. So which means that correspondingly, if you the situation you would not exercise was this: when the price fell below where you had to, the asset is worth 30, but if you were to buy it using the option, you would have had to pay 60. So it was not worthwhile exercising in this situation. So you can see this happens when the option, when the underlying price is below the exercise price. So when you are long on the call, if ST minus X is less than 0, so that's when you would, when ST is less than X, you would decide to not exercise. And therefore, your corresponding payoff would be what? Since you're not exercising, that means you don't need to do anything. You basically decide, I'm not going to use this option. I will let it expire, which means that you don't have to pay the fixed price, and which means that the option seller doesn't need to give you the asset. So which means that your payoff is just going to be 0. Nothing happens, basically. Okay. So that is the possible payoffs you can get in the two situations. And for completeness, you can see there's also going to be the knife edge case. What happens when ST is just equal to X? So that's kind of like where you're indifferent between the two. So you can see, given this structure, if you take, whether you decide to exercise it or not, essentially your payoff is just going to be 0. Is that clear? Because even if you exercise the option, in this case, you would be, the asset is currently worth 60, and you're paying the exercise price, which is also 60. So there's no additional payoff that you're getting because of this option. So this would be the structure. So if we show this graphically, this is what it would look like. So if we mark this point over here as X, so this is the point where ST is equal to X. So at this point, it is 0. And then what we see is that if ST is greater than X, the payoff is going to be positive. It's going to be in the positive region. And what we see is that given that this X is a fixed amount, that exercise price is not changing, as the stock price rises, then your payoff is rising linearly with that. So which means that your payoff diagram is going to look like this. So it's increasing with that ST. So that's to the area to the right of this. Similarly, if we're to the left of this, when we're in this situation, when ST is less than X, you will not exercise. So therefore, your payoff will just be 0. So it will be essentially horizontal at this point. So this is what the payoff diagram looks like for a long call. Is that clear what this is? Everyone clear why the diagram looks like this? Just some other terms that they use in this situation. So you can see that there's a situation where you decide to exercise the option. In the case of the long call, that happens here when ST is greater than X. So the term they use for that is they would call this situation, if I draw like a dotted line, this situation, we would say this is in the money. The option is in the money. But so this is the concept of that moneyness. So essentially whether the option has value or not. In the case of a long call, this happens when ST is greater than X. If instead you're in this area, ST is less than X, we say that the option basically doesn't have any value because you're not going to get any payoff of that. So because of that, we say the option is out of the money. And in the knife edge case, in this middle section, where ST is just equal to X, we would say it is at the money. Okay, so those are just some terms that they use. You don't need to worry too much about that. Those are just some technical jargon that they would use. Is that clear? So that's what you have for the long call. So then if you want to figure out what is it for the short call, the party that is short, essentially all you need to do is this. So if we again draw a diagram here, yeah, draw it this way. So you can see the short party has an obligation, which means that your decision basically just depends on, or your payoff will just depend on what the other party will do, on what the long party is going to do. So you can see in this situation, when when ST was less than X, the long party decided not to exercise the option, which means that he's not going to pay you, the short party, the strike price, and you don't, and he will not receive the asset. So if you're in that situation, that means that you basically, the short party, you don't need to do anything, because the seller, the long party decided not to exercise. So you also don't need to do anything. You don't need to pay the you don't need to receive the exercise price. You don't need to give that asset. So which means that in this situation, the payoff is just going to be 0. Is that clear? So it's going to be, so for the short party, it will be 0, since the other party is not exercising it. In contrast, if the party decides to exercise, if ST is greater than X, then you can see, if the party decides to exercise, then that means that the other party is going to make a positive payoff. ST minus X, it's positive, which means that from your point of view, the payoff to you is going to be the negative of this, because you're getting what is happening. If the long party decides to exercise the option, he is paying X and receiving the S, the variable. So which means that you're the party that is receiving that X and paying that ST. So given that we are in this condition, that means that this necessarily has to be a negative value, which means that if we draw this, and you can see that given that this X is a fixed amount, as this ST increases, essentially your loss is rising at a linear rate. So which means that this is what the payoff structure is going to look like. Okay, so you can see, notice between the two, the short party's payoff is basically just the mirror image of the long parties. So if you just know the long party's payoff structure, then the short party is just going to be a mirror image. Okay, is that clear? So that is the payoff that you're going to get. Then one additional element we can also introduce to this is, if we were to work out what is your profit from, so here what we worked out over here was the payoff. We can also work out what is the profit condition that you would need in this situation. So remember, the option, the long party is the one who has to pay that option price. So you have to pay that option price of C0, since it's a call option. So it's some positive value you have to pay. So the idea is you have to pay that upfront. So regardless of whether you decide to exercise the option or not, you still need to pay that C0, that option price, which means that if this is your payoff, then your profit after deducting that option price is going to be just basically, you just need to shift this down parallelly. So if you just parallelly move that so this is the payoff diagram. The profit diagram, you just need to vertically shift it down, parallelly shift it down. So it shifts down by the amount of that C0 payment that you need to make. Is that understood? Because basically, whether you exercise it or not, you still need to pay that price. Conversely, from the short seller's point of view, you're the party that is going to receive that option price, the call price, which is a positive value. So you're going to get this regardless of whether the other person decides to exercise it or not. So which means that your payoff is going to increase by that C0. So you just parallelly shift this upwards. So it will increase by this way. So these lines have to be parallel. So you get C0. So you can see this, you parallel shift downwards, this you parallel shift upwards, because you understood this part is the part that's paying the short party that call option price. So this is what the payoff diagram looks like for for a call option. Everything clear on that? So yeah, the important thing is to remember in what situation do you exercise it, what is the condition when you exercise it and not exercise it. So for a long call, this is the condition. So we can also say that in this situation, if you were to characterize it as like an identity, you don't need to worry too much about it. If you think what is the payoff to the long call, we can say it's basically this. It's going to be looking at this diagram. What we can say is that it will always be the maximum of between 0 or st minus x. So you can see from the diagram, always you're going to get at a minimum, you will get either 0 or you'll get some positive value. So because of that, the long calls, we would say the payoff structure, this is the identity for that. Okay, so that's just a bit of extra. So now if we move on to the put option. So let's say again, this is the payoff and the profit. This is the stock underlying. So let's say this point is X. So now we want to now remember you're the put option gives you the right to sell something. So if you think about the situation, if ST was greater than X, so it gives you the right to sell something. So if you think about it in the market, what we're saying by ST is greater than X means that if you decide to exercise it, what will happen is you will receive that X, you will receive that exercise price by delivering the asset. So in this situation, if ST is greater than X, that means that the asset you hold is more valuable than the exercise price that the price you're going to receive for it if you exercise this option. So which means that if you have the right to sell something, it is not advantageous for you to exercise the option in this situation. So you will not exercise. Is that understood? Because here you are selling it. So instead of selling it through the option, you're better off selling it in the spot market, because in the spot market, the asset is trading at a higher value. So you will not exercise, which means your payoff is going to be 0. That is, you don't need to give the asset, and therefore you don't receive the fixed amount. So your payoff is going to be 0 in this situation. Okay. Then instead, if you have ST, the converse case, if ST is less than X, so that means that in the market, if you were to sell this asset, you would get that ST, it's a lower amount. And if you went with the exercise price, it would give you a higher amount. Just to keep it concrete, if you want, you can just use some numbers to keep it in mind. For example, again, let's assume, say the same situation as the oil case. So the ST over there was 70, and the exercise price was that was given as 60. So in this situation, you're better off selling the oil in the market. You're getting a higher price. In contrast, let's look at a situation like this where it went to, was it 40 or 30? It was 30. 30, and instead the exercise price is 70. So in the market, if you was sold it, you would have got 30, but if you sell it using the option, you would get 70. So which means that you would want to exercise the option, and therefore you get a payoff which is going to be positive. So in this situation, in terms of the notation, what is your payoff? If you have got the right to sell, if you exercise it, that means you receive that X by paying that asset, by delivering that asset. So your payoff will be X minus ST, which in this case, given that X is greater than ST, means that your payoff is going to be positive. Okay, so if we now illustrate that here, that means that, and of course, same as before, the knife edge case is if ST is equal to X, then you're at the money, which means that even if you exercise it, your payoff is still going to be 0. So which means that now if you look at the areas, if ST is greater than X, that means that it's going to be 0. So it's going to be flat at this point. And then to the left of this, when ST is less than X, then what we have is that as the stock price is reducing, your payoff is going to be rising, because the exercise price is a fixed value. And as the stock price falls, the payoff will be rising linearly. So which means that it's going to go like this. Okay. And if you think about what is the value at this limit, so this is when the stock price has gone to 0. So when the stock price is 0, that's when you can get the maximum payoff, which is you just get X. So you get the full value X. So that is that payoff that you have. Okay, is that clear? So that is the payoff diagram for the long put option. If instead, if we now look the corresponding one for the short, so let's say this is our payoff. If you're short on the call option, so again, let's say this is the point X. It's a different color. So you can see again, if ST is greater than X, so in this situation now, the in the money is for the put option. This section over here where ST was greater than X would be the section where you are out of the money because you are not exercising it. So here you're out of the money. The points to the left of this, when ST is less than X, the option has value, you would exercise it, so it's in the money. And the section above it would be at the money. Okay, so so you can see this is a fundamental difference is between the point of when it's in the money or at the money. It's just, it depends on all it depends on is wherever the situation where you're getting a positive payoff, that would be the in the money situation. Okay, so in the case of the long call, in the money was when ST was greater than X. In the case of the put option, in the money is when the ST was less than X. So that's the key thing that determines whether the option has value or not. So that's what that moneyness is measuring. Okay, so that's how you can identify whether it's in the money or out of the money. So if you look at the payoff structure for the put option, then we can see if we are at X, if we're in this situation, we're out of the money. When ST is greater than X, that means that you will not exercise, which means that you as the option seller, you don't need to do anything else. The other party is not doing anything, so you don't need to do anything further. So your payoff will also be 0 in this range. Then to the left of this point, what do we see? If ST is less than X, the other party is exercising the option, which means that from your point of view, from your perspective, what is happening is you're the party that now needs to pay that X because the other party is receiving the X by delivering the asset. So you have to pay the X in exchange for this asset, which is now worth less. The worth is falling. So which means that in your case, your payoff is going to be negative. Given that X is greater than ST, your payoff would be ST minus X. So it's going to be a negative value. So which means that paralleling this, your payoff would be like this. And you can see, given that it's symmetric, you can see the maximum loss that you're going to make is that if the stock price goes to 0, you get an asset which is worthless and you still need to pay that X. So this point over here would be the minus X. So you can see it's the mirror image of this. Okay, so that's the payoff diagram for that put option. So similarly, if we were to look at the profit, again, same argument. If you're the long party, if you're the long on the put option, then you're the party that needs to pay that put price at the start. So you need to pay this P0, the put price. So you need to pay that regardless of whether you decide to exercise it or not. So which means that this diagram, it's going to look like this. You just need to parallelly shift this down by that put option. Just draw it properly. So this is basically this amount is being reduced by that put price that you need to pay. So the purple line would be the payoff diagram for the long put. conversely, the short party is the one that is receiving that fixed payment. So which means that their payoff is going to be increased by that P naught amount. So basically you just move this up by, you just parallelly shift it up, which means that this value now becomes P naught minus X at this limit. So this is what the put options payoff diagrams look like for the two parties. And if we, in notation, if we were to give what is the payoff for the put option, if you're the long party, then the value of that put option, the payoff is going to be given as the max of between 0. So you can see either you get 0 or you're getting a positive value. So it will be 0 and X minus ST. Because in this situation, you are receiving the X by delivering the ST, because it's given you the right to sell something. So this would be the equation for the payoff for the put seller, for the put buyer, sorry, the long party on the put. Okay, so those are the two diagrams. Any questions on that? Is that fine? Okay, I'm assuming everyone's okay with this. Then, yeah, so I think we already fully illustrated all of this. So that's what I showed over here as the different payoffs that you have. So as I said, you don't need to, if you remember the diagram, then you can figure out what is the payoffs. Or if you, if you just work it, basically it all comes down to just understanding those different ranges. So there are three possibilities: either ST is greater than X, ST is equal to X, or ST is less than X. So depending on those situations, you can work out what would be the corresponding payoffs that you're going to get for each of them. So, and also as you said, if you just remember what it is for one party, the long call and the long put, then you can automatically work it out for the short call. So for completeness, if we do in this framework, so we have ST is greater than X, ST is less than X. So if you're long on the call option, then if you go for ST is greater than X, that means that you will exercise the option, which means that your payoff is going to be ST minus X, which is a positive payoff. In this situation, you will not exercise. So your payoff is going to be 0. If you're the short call, it's basically, if you know what the long call's payoff is, then the short cause is just going to be the opposite of that. So what you do is you just take the negative of this value. So you can just take negative of ST minus X, which is going to be a negative amount. Okay. So if you open the bracket, basically then you get that X minus ST, which is a negative value. Here, because they don't exercise, your payoff is going to be 0. Is that clear? So if you just remember what is the long calls payoff, you just apply the negative to that to work out what is the short calls result. Similarly, if you're long on the put or short on the put, so with the long on the put we saw, when ST was greater than X, you would not exercise. It's not advantageous. So you will not exercise. So therefore your payoff was 0. When ST was less than X, you would exercise. It was advantageous. And you received X minus ST, which was a positive value. In the case of the short put, it's just going to be the negative of these. So you get 0 in this situation as well. Here you will get minus of that X minus ST, which is going to be a negative value. So this is the payoffs for the different options that you have. Okay, I think that should be fine. I think we discussed it in detail. Then yeah, then another important thing is this distinction between the two. I think I can annotate it directly on this as well. Yeah. So now this is about those factors that are affecting that option price. So if you think about it, if you're the call option price, if you look at the payoff diagram that we saw, so we saw that for the payoff, the payoff for the put for the call option was you get the maximum of 0 or st minus x. So if you think about it, if you have the call option, if the underlying price is increasing, we want to understand what happens to the option price. So the option price would be basically how much you need to pay to get this right. So if the option price is high, that means that this option has greater value. That's why the price is high for this thing. So we want to understand how do each of these factors affect that option pricing. So if the underlying price is high for a call option, so remember, a call option gives you the right to buy something. So you're paying a fixed amount to buy something. So if that asset price is going to be higher, that means if this is going to be higher, that means that all things being equal, the payoff is now going to be more, potentially going to be higher. Therefore, what you would expect is that the value of this option is going to be higher. So if the underlying price is increasing, the call option value is going to increase. Okay. In contrast, if you're the put option, you are the payoff is going to be max of 0 and x minus st. So in this situation, if the put option price, if the underlying price is rising, so remember here you have the right to sell. So you're selling an asset at a fixed price. So what will happen if the underlying asset value is increasing? So that means that maybe the payoff you can potentially get will be less, because if the underlying price was higher, then you might be better off selling it in the spot market than using this exercise, than using this option. So which means that the put price would be less. So the value of the put, the P naught, would be less in response to this. So you can see, you can easily figure this out if you remember this payoff diagram. Then you kind of have an idea, okay, that's the relationship. That's how it's affecting it. In the case of the exercise price, we would think in general, you can see that with the if you're the call option, you're the party that is you have the right to buy, so you're the party that has to pay that x. So if that x, the amount you have to pay is higher, that means obviously that the value is going to be less. So this is going to be it's going to drop your call price if this exercise price is high. Which means conversely, for the put price, where you have the right to sell something, if you use the option, you're receiving that x. So if the amount you're receiving is higher, that means that put is going to be more valuable. So this is going to be positive. Okay. Then in terms of the time to expiration, okay. So if you think about the time to expiration, there are two things that are affecting it. So one is whether if the option, it takes longer, you have a greater period in order to decide whether to use this asset or not. So basically the expiration date, if the expiration date is further away in the future, that means that the validity period of this option, if it is greater, then that's going to be a positive thing for you. Okay, because then you have more time. Because now when it comes to an option, if you're the long party, there is no downside to it, because I mean the worst that can happen is you can decide not to exercise it, and on the flip side, you can get a positive amount because you have the right. So given that, having more time is just going to be, it's by definition going to be a positive thing. So that's going to improve your value. So that's one way the time can affect the value of the option. Another way it will affect it is if is in terms of that exercise price you have to pay. So the further away, further ahead in time that you have to pay this exercise price, that means the cheaper is it going to be in today's terms, because now today you entered into this option at time t naught. Now, if you decide to assume it's a European option where you need to exercise this only in the future, in that expiration date, at that final expiration date. So if that date or that final expiration date is further away in the future, what can we say about the price you have to pay? So if you decide to exercise the option, that means you have to at some point pay that x, that amount x. So so if you think in today's term, the amount of x you need to pay would be given by that x over that 1 plus rf of t. So in other words, the present value of this X is what you're going to, if you evaluate it in today's terms, this is the price you have to pay if you decide to exercise that option. So you can see if you're the call option holder, if you're long on the call, you're the party that has to pay the X. So the further away in the future it is going to be, the higher this T, which means that the lower will be the present value of this X. So the lower the present value, that's a good thing for you, because essentially it's like your cost is effectively going down. So which means that this is also going to positively impact your call option value. So which means that both of these effects are moving in the same direction. So overall, it's a positive result that you have. When it comes to the put option, the first one, having more time to exercise it, it's a good thing for you. As the giving you the right to sell, because then there's a higher chance that the stock price might fall, and therefore you might get the chance to exercise the option. So this first condition, it's also going to be a positive. But when it comes to the second condition, so remember, if you have the right to sell something, if you exercise the option, you will now receive that X. So if you're going to receive that X amount further ahead in the future, that means in present value terms, the amount you're going to get is going to be less. So which means that if the time period is going to be greater, because the X you're going to receive in today's term is going to be less in present value terms, that is going to have a negative impact on your put option value. So because the two effects are working in opposite directions, we would say this is an ambiguous situation. Okay, so it depends on the size of the two effects. Then the other thing is mechanically we can look at in terms of the risk-free rate, what happens when that increases. So it's kind of more or less goes in line with this impact on the exercise price. So you can see if the exercise price is increasing, if the risk-free rate is increasing, you can see from this formula, if RF is increasing, all things being equal, this would now be a smaller value. So which means that if you're the call option holder, you need to pay this X. So if the risk-free rate increases, the present value of X is falling. So that's a good thing for you. So therefore your value is going to increase. In contrast, if you're the put option, the present value of the X is falling. You are supposed to receive the X if you decide to exercise the option. So which means that since the value is going to be less, the value of the put option is also now going to be less. So that's how it has an impact. Then finally, in terms of volatility. So volatility means that's the possible swings in the stock price. So if the thing is more volatile, as you said, since you have the right, whether you're the call option or the put option, you have the right. So you don't mind whether, so if you're in a situation like this, where, whether the stock price has fallen or not, you don't, so if the stock price has fallen and you don't have to exercise it, you basically, even if the stock price falls, if you're in the call option, you don't need to do anything. You don't care how much the stock price falls, because you will not exercise it. Nothing will happen to you. You will still get zero. So because of that, you don't really need to worry about it. So in that context, what will happen is, that means that what you will do is, higher volatility is a good thing, because now it increases the chance that you can move in the money. So because of that, the volatility is going to be a good thing, whether you have the long on the call option or the put option. Then lastly, in terms of the costs of holding the asset. So usually if you're the party that is so now if you think about the call option, it gives you the right to buy something. So at the moment you don't own the asset, but you can own it in the future. Okay, so right now you don't own the asset, and the call option gives you the right to buy it in the future. So if the cost of holding the asset is increasing, all of these terms we were looking at increasing cases, if the cost of holding the asset is increasing, that's a good thing for the call option, because you at the moment don't have the asset, so someone else is bearing the cost for that. So which means that the call option allows you to not hold the asset, because in the future only you can decide whether to go for this asset or not. So that's going to increase the value of the call option. Whereas when it comes to the put option, what you will have is what you have is that at the moment might be the case that you currently own the asset. Okay, that's why you want this right to sell. The thing you currently have the asset and you're trying to get rid of it with this put option. So because of that, in that situation, it could be a negative. Okay, the value might be less. In the case of the benefits of holding the asset, so you can think maybe like a stock or something, which is paying you dividends or things like that. So in a situation like that, if you're the call option, you currently don't own the asset, so you don't get that benefit. So which means that if the benefit of holding the asset is more, that means that the value of that call option is going to be S. Similarly, if you're having the put option, you currently own the asset. You have the asset with you and you have this right to sell. So if you have this additional benefit, then the value is increasing. So that is increasing that value. So that's kind of how this works. So these are the different factors and how it affects the option prices. Is that clear? Any questions on that? Okay, hope everyone's okay up to that point. Okay, now let me just erase everything. Now, another fundamental thing that we need to know, this is I think the final section we didn't go into, is the put call parity relationship. So to develop this put call parity, we have this framework of this concept of the fiduciary call and the protective put. Okay, so we know that put call parity relationship is given by this identity, that's C naught plus X 1 plus RF T is equal to P naught plus S naught. So in this sorry, so in this identity, the left hand side is what we term as the fiduciary call and the right hand side is what we consider as the protective put. Okay, so to give you some intuition as to why it's named this, and sort of like to in a way to sort of remember this put call parity, think of it in this way. If you go long on the call option, so here when you have a positive value, that means you're long on that particular asset. So if you go long on the call option, that means that you are you have the right to buy this. So which means that at some point, if you decide to exercise this option, you need to make sure that you have enough cash with you. You have that exercise amount in order to make this exercise payment, to make that payment. So a fiduciary call is basically like you're preparing for that situation. So what you do is you go long on the call and you also invest in a risk-free asset. So you can think about, you put some money aside today when you buy the option. When you buy this call option, you also put some money aside in this in the bank account, which gives you this risk-free rate. Okay. So that's because the main idea is that in the future, when you have to decide to exercise this option, that money that you save, you'll be able to utilize it to pay for it. Okay, so that's the main idea with this situation. So if this is the case, then what you do is today at time t naught, I'll put another column here, at time t naught, if you think about the cost that you're going into, so how much you have to pay for all of this. So if you're buying the long call at time t naught, you need to pay that call option price. So you need to pay C naught to buy this. Then what are you also doing? You're investing in the risk-free asset. So you're depositing some money in the bank. So the amount that you're depositing will be given by this X over 1 plus RF T. So you're investing the present value of that exercise price on this underlying on this particular call option that you're going for. So that is the amounts that you are investing at the start. Okay, so then when S increases, when S is greater than X, that means that what will happen in this situation, if you are long on the call, you will exercise the option. So therefore, you get ST minus X is what the payment is going to be. Okay, you're going to exercise the option. So you receive S and you need to pay that X. So now the thing is, since you've exercised the option, you're not worried because you have put this amount of money in the bank. So you have at time T, this amount will grow to, since you're getting a rate of return of the risk-free asset, this amount X over 1 plus RFT will grow to X in the final period. So this is all at time T, at the expiration point. So which means that this is the net payoff you're going to get is just ST. Okay, here you need to make a minus X the payment, but luckily you have put that money in the bank, so you're getting X amount. So that and that cancel off, so you just have ST as your payment. In contrast, if we were here, when S is less than X, that means that what will happen, if you have the call option, you will decide not to exercise it because it's not advantageous. So this is going to be 0. But if you see, but you have still invested in this risk-free asset, you're still going to get that amount X. Okay, that's by definition, it's a risk-free asset. You're still going to get that regardless of what happens. So because of that, your payoff in this situation is going to be X. Okay, so that is the fiduciary call. So just remember that intuition to understand what goes into the fiduciary call is that you buy the right, you buy the, you're going long on the call option, and to prepare for the fact that you might need to exercise this option, you also put some money in the bank account. Is that clear? Then for the protective put, a similar set of logic. So with the protective put, what you do is you go long on the put option. So now if you think about, if you've gone long on the put option, what happens? You are effectively, what you're doing is you're saying that you're getting the right to sell this asset. Now, if you think about in this situation, if you were to exercise the option, then what do you have to do? You receive the X, but you need to now deliver the asset. You need to give the asset. So if at that point, you need to make sure that you already have the asset to deliver. So because of that, you combine the long put by going long on the underlying, on the asset. So that is, you're buying the asset as well. So you own the asset and you also buy a put option on it. So that's why it's called a protective put. So if you think about the cost of that today, of implementing this, the cost is going to be, today, if you buy the put option, you need to pay the put price. So that's P naught. Then you have the underlying. So today you go to the spot market and buy that underlying. So currently, let's say the asset is worth S naught. So this is how much you invested. So now what happens? You now, these are the two investments you have made. So now let's look at what happens at time T. If S is greater than X, we know in this situation, if you have the put option, it's not advantageous for you to exercise it because you're better off selling it in the spot market. So you get 0, you don't exercise. But you still have the asset with you. So the asset is now worth ST in this period. Okay, because you don't have to give the asset because you didn't exercise the option. You're still left with the asset that you initially bought. So in net, your value is going to be ST. In contrast, if you go with if S was less than X, so in this situation, it would be advantageous to exercise the option. So you get X minus ST. And in that situation, you get the long, the underlying. So this is how much you need to. So at this point, that means that you need to now give the asset because you're selling the asset. But luckily, you already own the asset. So because of that, you can just deliver whatever the asset you had, you can give it up. And you net basically receive that X. So if you add this up, the net payment you're getting is that X. Okay, so this is what we have here now is the fiduciary call and the protective put. What are the corresponding payoffs you're going to get in the different states of the world, and what is the cost of forming it? So you can see what you realize is that the payoffs are the same for the corresponding payoffs for the fiduciary call and the protective put are the same. So what they would now argue is that if you if since the payoffs are the same, to prevent arbitrage, what should happen is the cost of this fiduciary call, of creating this fiduciary call, has to be the same as the cost of creating this protective put. So in other words, the costs have to be equalized. So which means that the cost of the fiduciary call is this C0 plus X1 plus RFT, and the cost of protective put is P0 S0. So those two have to equalize. So that's where we get this relationship, which is what we call the put call parity. So that is the result. So that's where that is derived from. So just keep in mind the put call parity is coming from that fiduciary call and the protective put. So if you forget the formula, this is how you can understand how that can arrive at. So just remember what is the definition of the fiduciary call, what is that protective put, and then you should be fine. Any question? Is that okay? So this is a very useful result. So a lot of questions will sort of like be based on this as well. Okay, any questions on that? So you can unmute your mic or just send a message on the chat if you have any questions. Yeah, not seeing any other questions. So I'm assuming you all are fine with this. Then getting into the put call parity. So this is what I was explaining. Let me just clear this. So this was the result. And so the usefulness of this protective put, the put call parity, is that you can use this to then formulate any sort of asset that you want by just rearranging this identity. Okay. So what it allows you to do is you can just rearrange this expression to create all sorts of what we call synthetic assets. Okay. So what you can do is, for example, if you are in a particular market, there is no call option for this thing, but maybe it has a put option, maybe the underlying is there, etc. So you want to create some synthetic asset using it. So what you can do is, using this put call parity relationship, you're able to formulate that. So over here, let's say we have, so the put call parity relationship is this: X over 1 plus RFT is equal to P naught plus S naught. So say we want to create a synthetic call option. So quite simply, what you need to do is, so essentially what we mean by synthetic call is using other assets, can we replicate the payoff of this call option? So you can see all you need to do is, if you just rearrange the identity to make whatever the term we are interested in, the subject, then that is the particular combination that we need. So for example, if we want to create a synthetic call, we just need to make synthetic call be equal to P naught plus S naught minus X over 1 plus RF T. So what we have is that the right hand side, what it shows is the combination of investments you need to do to create this synthetic call. So if you look at it, what do we need? You need to go long on the put. You need to go long on the underlying. You need to buy the underlying asset, as well as you need to, here we have a negative sign. So a negative sign means in this context, you have borrowed. We need to, you borrow or you short sell. So here what means is that from the bank, you have borrowed this present value of X. Okay. So this combination tells you what is the combination of instruments you need to do in order to get a payoff that is the same as a call option. So you can sort of prove that, you can do that quickly on this combination. So we saw that these were the combination of assets that we needed to create this call option. So let's look at the two scenarios. So the two possibilities are ST is less than X, ST is greater than X. So we know if you go, if you're long on the put option, if ST is less than X, it is advantageous for you to use the put option, and you will get X minus ST. The call option, ST is less than X, it would be out of the money. So you would not exercise it. So you get 0 in this situation. And then over here, what would you get? X is, sorry. Sorry, did I miss something? Sorry, this is the sorry, this was the you have gone long on the underlying. So which means that you are getting, you had the asset was initially worth S naught. Now it's going to be worth ST. Okay, this was because you bought the asset at the spot market at time naught, S naught. Now the asset is worth ST at this particular situation. And the exercise, the present value of the exercise, so you have borrowed this amount of money. So which means that at time period T, you need to repay that with interest, where the interest is at that risk-free asset, risk-free rate. So which means that at time T, you need to repay this amount, which is minus X. So now if you add up the terms together, you can see you just end up with 0. Everything cancels off. So that's what you get when you combine these three assets. Similarly, if you look at ST greater than X, then what we have in this situation, the put option would be out of the money. So you would not utilize it. So that's 0. Here the asset would have value. So it will become ST. And here you still need to repay that debt, that borrowing. So that is minus X. So which means that the payoff is going to be ST minus X. So what do we end up with? What did we see? By combining these three instruments, we have got a payoff which is resembling that of a long call option. Okay, so you can see in this situation when ST is less than X, you get 0. So same as like a call option that is out of the money. When ST is greater than X, you get ST minus X, which is some positive value, which is again what you get when the in the call option when it's in the money. So you can see what you can do is you can just rearrange this formula to get whatever you want, to create a synthetic asset of anything. If you want the synthetic put option, just take everything else to the other side and make the put option the subject, and that is your synthetic put. You want to create a synthetic asset, just take everything else to the other side, and that is your synthetic asset. So that's the logic of this, using this synthetic call to create these instruments. Okay. Yeah, so I think in this session, we will not be doing any questions, but if you found this session effective, we can potentially do a follow-up session where we'll discuss some sample questions with this. So let me know in the feedback afterwards if you found this session useful. We can arrange to have a follow-up where we can do these questions. So then, yeah, this is just a small thing with this put call forward parity theory. So essentially here, what's happening is that we're just replacing that asset with the forward contract. Okay. So that's just a small change that we're doing. So instead, so in this put call parity, that forward contract on that asset, which is, you know, if you've gone long on a forward contract, you're basically getting delivered this particular asset, which has a value of F naught. That is the forward price that you're taking. So in this put call parity, we just replace that, the asset with the present value of that forward rate. So that's just a minor thing, not something to worry too much about. But the critical thing is this put call parity and remembering how you can rearrange the assets to get that the different synthetic calls that you can formulate based on this. Okay, yeah, so that's basically it for the session. Does anyone have any questions regarding this or any comments? And I think probably immediately after this, there is a feedback form you can fill out and you can give what your feedback was on this. Okay. Yeah, so just let me know if there's anything we can do to like improve this. So if this was, if you found this useful, just give out, put your comments in the feedback form, and we'll look to organize a follow-up session to this to discuss some questions. Okay. Yeah. So I mean, given the situation right now, we might be probably might be able to have it relatively soon as well, since I think tomorrow is also a public holiday. So if there is again a lot of interest, we might be able to do this relatively soon, this follow-up session. So after this, I will also share these slides. Will be shared as well as the whiteboard drawings. I'll be able to give you a copy of that, as well as this session will be recorded as well, so you can view it later as well. Okay. Yeah, so if there's no other comments, any questions, just wait a bit. If not, yeah, if not, we are done with this session. Yeah, just let me know if you have any questions. I'll just stop the sharing for the moment.